Very good evening to all of you. On behalf of Auditing and Assurance Standards Board of Institute of Chartered Accountant of India, I welcome you all in today's 147th CP program organized by AASB of ICI for this council year. I would like to share with you that today's 147th CP program in the form of webinar. And again, the topic of today's webinar is very important. That is the audit materiality and misstatement identified during the audit. And we are having with us two very learned members from our Chartered Accountant fraternity, C. Ashish Gupta ji and C. A. Gaurav Bhatia ji. So I welcome both the learned speakers, C. Ashish Gupta ji as a speaker and C. A. Gaurav Bhatia ji as a moderator in this AASB platform. Welcome to you, Ashish ji. Welcome to you, Gaurav ji. Gaurav Bhatia ji is also a associate partner, executive partner in ASN firm, and Ashish Gupta ji is also a very learned speaker at various forums. He has given various lectures at Institute of Chartered Accountant of India platform in the form of physical seminars as well as the various webinars. He is graduated from Shri Ram College of Commerce and in the audit at a large audit firm in Delhi, Wakil Chandiok and Company LLP, and he has gained experience of auditing some of the largest companies in India across sectors. So he is covering various sectors and he is having the vast knowledge in auditing. And today we are fortunate enough that he is going to share his expertise with all our members in these two standards. So once again, thank you so much, Ashish ji, for giving your kind consent to deliberate on these two very important topics. And thank you so much, Gaurav ji, for giving your consent to moderate as well as handle this webinar today. So without wasting much more time, I request Gaurav Bhatia ji to please start the proceedings of today's webinar. Over to you, Gaurav ji, please.
Thank you, Anil ji. And good evening, everyone. A very warm welcome to all of you to this webinar organized by AASB of ICI on this very highly pertinent topic, I would say, on audit materiality and evaluation of misstatements identified during the audit. I think there's been a series of these webinars on the standard of audits with respect to various audit standards being covered. And if you ask me, I think this is one which is very important for all the members of the fraternity who are conducting the audits. So, in fact, so I'm honored to be moderating today's session, and we are joined by a very esteemed speaker, as Anand has rightly mentioned, Ashish Gupta ji. And he's having extensive experience in the field of audit and assurance, and I'm sure he will bring valuable insights into the complexities of audit materiality and the process of evaluating the misstatements. So I think both of these aspects are very crucial in ensuring the accuracy and integrity of the financial reporting, and that's what the ultimate objective is. So to set the stage for our conversation today, let me first touch upon why this topic is both timely and critical with respect to the evolving audit landscape which we have today. So audit materiality, I would say, is the crux of the audit process. It is the cornerstone of the audit process. It shapes the auditor's judgment on what is considered significant to stakeholders and drives decisions accordingly, right, with respect to both reporting and risk assessment. So while any risk is being identified, it has been assessed, there is a response which has been created now, and the next step is with respect to the evaluating the overall impact, right? What will it have? Understanding and evaluating that how this is going to impact the overall financial statements and how the opinion will be accordingly created on that. So that's why it's a very important topic from that aspect. Also, with respect to the evaluation of misstatements identified during the audit, it plays a very crucial role in with respect to the overall accuracy of the financial statements. And I believe in today's time, the stakeholders expect not only transparency but accuracy as well from an organization, right? Maybe as an auditor, we don't say it's incorrect. We say it's true and fair with respect to the overall opinion we are making. But from the stakeholder perspective, they have started thinking that whatever is coming is accurate and there is no room for any kind of anomaly whatsoever. So that's the reason why materiality and understanding that what is this overall concept of materiality, how it is calculated, how it is the audit procedures are performed accordingly, becomes very, very important. So, from my side, a quick one on a theme address. Now, I would welcome CA Ashish Gupta to the forum, and over to you, Ashish ji.
Thank you, Anil ji, and thanks, Gaurav, for setting the context. And I'll just sort of sort of further elaborate on, very well articulated uh, opening that you've really started the session with. Friends, as we all know that, at the end of the day, the objective of the audit and as auditor is to opine on the financial statements for, of course, annual audits or draw conclusions in case of reviews. And in both of these aspects, the fundamental basis of opinion is materiality. And the users of the financial statements or the audit report are not really bothered about insignificant items or inconsequential items. What they want an opinion on or a conclusion on, that there is no material misstatement to the financial information that they are relying on. And therefore, the judgment of materiality is absolutely critical, both at the time of setting up the audit and at the time of concluding the opinion. And why I'm differentiating, and I think Gaurav also initiated that very well, is that there are two different concepts. One concept is under SA 320, the other concept is under SA 450, which is evaluation of misstatements. Now, as we set up the audit, friends, we all know that we start, of course, with the very basic stuff of doing a risk assessment. That's why you would say sequentially risk assessment comes before materiality. The risk assessment standard is SA 315. Now, what the standard requires you to is to determine where are the areas that the auditor needs to focus on, depending upon what could go wrong. So what could go wrong would be either, in different classes of transactions or for different account balances, or with respect to certain inherent nature of the industry that the company operates on, which will of course have or could have an impact on the financial statements taken as a whole. For example, highly regulated entities like electricity companies, power companies, financial services companies or entities, so which are highly regulated. So once we've determined a risk or we've done a risk assessment, between risk assessment and drafting a response to those risk assessment to audit procedures, the audit materiality comes in as a very important tool to link both. Because you may determine, for example, that in a financial statements of a company that has 10,000 crores of balance sheet, 3,000 crores of turnover, for example, that you may believe that, for example, certain classes of transactions, let's say related party transactions with the promoters, could be, could lead to a material misstatement or could lead to a misstatement. Let me start with that. So you may believe that, company may not be able to appropriately capture or disclose the transactions with the promoter family, for example, right? Or you may determine that you believe that there are certain classes of transaction like advances given by the company, which are recorded as advances or either as financial assets or non-financial assets, depending upon the nature of those advances. That those could be given to those may not be recovered or may not be appropriate in the first instance in terms of the transaction value. Now, when you do that risk assessment, the question is that should you prepare a response to every of those situations? The answer is not necessarily yet, that you have to prepare a response. So assuming that there are no qualitative aspects to each of those transactions, you'll have to still determine what is the value that is there on the financial statements, all in the trial balance of those underlying transactions. So the example that I took from the advances which are given. Let's say the value of the advances on my balance sheet of 10,000 crores is like 20 lakhs or 30 lakhs or 50 lakhs, right? Do you think that tomorrow, even if you were to not, the company was not to recover those advances, again, assuming that there are no qualitative aspects involved here, uh, but those clearly are not really material, right, to the overall financial statements. If they are not material to the financial statements, then should an auditor really draft a response against that? What could go wrong? And that is where the linkage of audit materiality really comes in. So whenever you determine a response to the identified risk, you have to test that response for appropriateness, both from the quantitative and qualitative aspects of materiality. And SA320 actually elaborates what is the quantitative aspect of that materiality in particular, right? And we'll come to, of course, the qualitative aspects later on, and when we talk about the SF 450 and so on and so forth. Now, in doing so, the standard, puts down a guidance for all of us to say that what would be the different aspects that we as professionals, as members of the institute, as auditors, need to determine while we are computing or arriving at an audit materiality. The simple question should be, for the company or financial statements taken as a whole, should it be, for certain caption of transactions, should be for certain account balances, should it be for disclosures, uh, you know, what are the benchmarks I should use? All of these are specific questions that you would typically ask. And what I will try and do in this session is to cover those aspects in some detail. I'm not going to rely a lot on the presentation. A lot will come from the experiences that I have with respect to the audits that I've done. And therefore, please do send in your questions to Gaurav and the AASB team if you want me to elaborate anything further or specific. So what I'll do is that I will finish my session, somewhere around 6:30, another hour and a half, or less than an hour and a half now, and then leave about 30 minutes for any questions that you may have, because every situation is different, and I think it's important that adequate time is given for you guys to ask those questions. So what I'll do is I'll just start sharing my screen and set the context in terms of the sequence I would want to draw your attention, and then we can take it from there. Just give me a minute. Gaurav, just let me know if this is really visible to you.
Yeah, Ashish, it's in process. I can see it now, yes.
Okay, awesome. Right. So I think really the concept of materiality, which I think, uh, as I was elucidating to, is that it establish a linkage and gives a direction in terms of whatever risks that we have identified through an SA315 process. And when we draft our responses to those assessed risk of material misstatement in financial statements, how should we factor in that we only have a response for relevant, transactions or account balances, which helps us form an opinion? Because at the end of the day, we can't be auditing the entire transaction set, right? We can't be auditing the all the transactions, all the classes of transactions, all the account balances that are there in the financial statements, all that happen through the year. That we cannot do, right? Because of this is not required under the standards, but also the fact that at the end of the day, you can only do so much in a given period of time, right? And if we are to find and form an opinion, our opinion, as I said, is not to demonstrate true and correctness of the financial statements or to opine on the true and correctness, is to opine whether the financial statements or the financial information, as the case may be, whether it's under 700 or 800 or 805, whatever uh, you know standards you're using to opine on the financial statements, whether the financial statements or financial information underlying is true and fair. So, so therefore, the materiality essentially is that linkage between risk assessment, response to risk, and therefore any immaterial transactions, we don't necessarily need to respond unless there are qualitative factors, and I'll touch upon that at the end of this section as to what those qualitative factors could be, right? But starting with that, so materiality, therefore, when you define materiality, the principle of materiality really comes in terms of whether, or rather, let me rephrase this. The concept of materiality really comes in terms of determination of what is the right benchmark of materiality, which essentially is driven by what is the size and nature of the operations of the company. So let's say it's a startup company. You're auditing a company which is like zero revenue, only expenses are being incurred, there are certain assets or there are certain contributions made by the promoter or the capital provider, right? In that case, what is the benchmark of materiality in determining what is relevant for the users of the financial statements? So first of all, you have to determine what is the size and nature of the underlying entity. Then you have to also look at if there are any other aspects which are relevant for the users of the financial statements. Because at the end of the day, uh, our opinion is going to be used by either the general public if it's under 700, or for specific reason if it's under contractual or under any legal obligation, or for example, there's many situations where the companies require under a contract to get a special purpose audit. So depending upon what is the user of the financial information, that is where you will determine what is relevant for that user. In a general purpose financial statement, typical aspects which are relevant for the users of the financial statements would be if it's a revenue generating entity, revenue, uh, profits. If it's really, not, it's an early stage startup company, or, not so profitable company, not an early stage, but still not profitable company, then maybe aspects of assets. If it's a very asset heavy company, let's, for example, a lot of times you have these, solar companies or these renewable companies, which are typically driven by very assets heavy investments. And therefore, what is the right benchmark could be the investments made in that, or let's say intermediary holding companies, where you're auditing, the company, all that company has is basically capital provided, investments made in different entities or in mutual funds or wherever, if it's basically just the investment company. So in that case, revenue, profits may not be that relevant. What is more relevant are the investments. So you have to determine who the user of the financial information is, right? And then second is that what is relevant for that user of that financial information. So if the user of the financial statement, as I said, is general public, therefore you're issuing opinion under Section 700, in which case then you do a classification of what stage and size the entity is, what is the nature of operations of the entity. If the entity is an early stage startup company, then revenue or profit may not be the relevant matrices for the user of the financial statements. What could be the relevant matrices? Could be, the assets deployed, or let's say the gross value of transactions which are, let's say, recorded at net value or not recorded, as the case may be, or it could be liabilities, or it could be the capital contributed. So you have to determine that stage. For, as I said, for a late stage company which is already revenue generating, profit sort of generating, then revenue or profits could become a relevant benchmark. If it's a asset heavy company, then asset could become a more relevant. So again, determine who the users are, what is relevant matrix for the user, and then set the benchmark for yourself to determine what is materiality and how would you really compute that materiality. Now, in doing so, let me introduce the concept of a performance materiality. Now, we've all heard about audit materiality very conveniently, that whether it's material, not material, all of that. For you to opine on whether a transaction is material to the financial statements, or whether the audit procedures are sufficient enough to be able to determine that there are no material misstatements, you have to make sure that there is adequate work done, right? So let's say, go back to my original question. Let's say there are 3,000 crores of revenue transaction, revenue volume and value, and that revenue comprises of millions of transactions, small value transaction, which add up to 3,000 crores. Now, with those millions of transactions, can you audit each of those millions of transactions? The answer is no, right? So you'll have to still, therefore, pick up a sample size, right? When you respond to that risk of, let's say, revenue not appropriately recorded as a risk, and you will pick up a sample size of those millions of transactions that form part of the 3,000 crores. Now, in doing so, what is the objective? The objective is that you are able to identify sufficient samples from that population of millions of transactions of 3,000 crores to be able to determine that if there is any misstatement, that misstatement is not either individually or in aggregate, will not lead to a material misstatement in the revenue number itself, right? So therefore, there are two things involved here. A, to determine that how many transactions you should be auditing in that population, right? That's one. And making sure that whatever errors that come in, if there are errors that come in, they will never in aggregate be more than the uh, materiality relevant for your opinion, right? So there are these two things. Now, in determining and drawing out the sample, the principal point here is that you will determine a materiality because your drawing of the sample is directly proportional to the amount that you determine as materiality. Because ultimately, the sample size is a simple, any mathematical formula that you determine is nothing but a population divided by a quotient of materiality, which will then give you a sample size. So as I said, millions of transactions. If you determine material to be 100 crores, then it'll throw up a different sample size. If you determine the material to be 200 crores, it'll throw up a different sample size. So it is directly proportional to the sample, to the materiality that you drive. Now, therefore, the concept is of performance materiality to say that what should be the level of materiality or amount that you will determine that will be applied to those transactions, millions of transactions, to that account balance, to draw out adequate number of samples to be able to draw a comfort as auditor that we have done sufficient procedures and appropriate procedures to be able to conclude that that sample size reflects the overall population and that there would not be an error if, unless otherwise noted, that if my test samples are satisfied, then that they would, the chances of any material misstatement in revenue are remote or less likely. So that's the whole concept. Therefore, I'll define the material performance materiality, which is there in the standard. It says that performance materiality means the amount or amount set by the auditor, which is less than the materiality of the financial statement. As I said, there are two concepts. One is to determine how many samples I need to draw from that underlying account balances or transactions that I'm testing, right? To opine on the finance statement. So it has to be an amount which is different from the materiality of the financial statements. As said, to reduce to the appropriate low level of probability that the aggregate of undetected misstatements exceeds the materiality of the finance statements taken as a whole. Now, these are very important words here. First of all, amount or amount.
So, yeah, I think we can't hear you. Someone from the team, can you please check with Ashish? I think there is some connectivity issue maybe. Okay, let's wait for him to rejoin.
Sorry, apologies. Am I back now, Gaurav?
Yes, Ashish, yes. I think
Sorry, I think there's some network issue at the location I am in. I don't know whether let me share my screen again. It's visible now, Gaurav?
yes.
Technology at times works beautifully. So that's where we are. Anyways, I think I'll just take back to the concept I was trying to explain that whenever you're planning or you're determining materiality for the purpose of planning and performing an audit, the concept of materiality has to be looked at with respect to A, what is the amount that I select as performance materiality to be able to draw out adequate samples, or let's say perform adequate procedures for me to conclude as an auditor that for the unseen transactions, right? For the unseen transactions, the amount of error is not likely to be material on the financial statements taken as a whole. That's the underlying principle. And therefore, your performance materiality technically should be lower than the materiality that you determine for the financial statement. So always remember that there are two materiality concepts. And I've seen many a times people confuse between an audit materiality and a performance materiality. And therefore, it's important that that aspect is fairly well explained to the people who are members who are joining or students who have joined. Whenever you determine, this financial statement materiality, as I said, you will look, I'll recap slightly. You will look at A, what is the use of the purpose? Therefore, who are the users? And then what is the benchmark that is relevant? What is the thing that they look at? That's your audit materiality, right? Basically, what is that benchmark? And then basically that benchmark, you determine, yes, if it's a late stage company, it's revenue or profit which are relevant. And therefore, I would determine materiality to, and when I say, financial statements as a whole, I will make sure that I do enough procedures drawing out my benchmarks from either revenue or profit, which will be applied to the entire financial statements. That's the audit materiality. But for me to perform procedures, I will have to make sure that I will choose a materiality which is less than the one determined in the first step. Right? Why is this so? As I explained earlier, because my transaction testing is only on a sample basis. And when I'm determining on a sample basis, I will have to make sure that whatever I'm not testing directly, which I believe is representing on the entire population, the chances of any material misstatement arising from the undetected or unseen transactions is not likely to be material. So therefore, my performance materiality will be slightly lower. The other important aspect to which I again get a lot of times questions and queries is to say that do I determine one single performance materiality or do I determine that at multiple levels? So let me take an example here. Let's say a company which is a trading company that has simple revenue, purchase of stock in trade, then you have certain expenses which to run the organization, then you have the profit, then you have taxes and so on and so forth. The balance sheet is fairly straightforward. It has a contributed capital, which is not really material or significant because it's a trading company. Then you have inventories, then you have debtors, basically working capital, some bit of cash balance, and the liabilities to vendors. Now, in a simple organization or financial information of this nature, one would be to say that okay, I determine overall audit materiality basis, let's say revenue, because it's a trading organization and profit may not be the relevant benchmark that the users are looking at. Users are possibly looking at revenue as a more relevant benchmark. And I determined, let's say 5%, and this is again, nothing is really cast in stone in the auditing standard. That depends on the judgment of the auditor. In my view, 1% to 3% is the most relevant benchmark for determining materiality for a revenue transaction. But I mean, I've seen companies or audit firms take a different view on that. Let's say I've taken 1% of the revenues as the relevant audit materiality benchmark. In an audit materiality benchmark of 1%, which means let's say if it's a 500 crore revenue company, 1% of 500 crore comes out to be 5 crores. Now, I believe that the 5 crore is my audit materiality for the financial statements that are taken as a whole. To determine now in this nature of an audit, what do you think will be the relevant risk areas? Relevant risk areas will of course be on revenue. The relevant risk areas will also be on inventories, whether the cost of inventories are appropriate, whether they exist or not. If it's a trading company, which means that it's a high volume transaction, so you'll have to really look for whether the inventories are aged or not, or whether appropriately cost attribution has happened or not. You will also look at whether there are any aged receivables or not. You'll also look at if the vendors if there are any arrangements with the vendors for any discounts and all. So whether all the liabilities are recorded or not. So there are different attributes that you will test the financial statements for. One way of doing it is that you say, okay, I'm going to draw out my performance materiality for the financial statements taken as a whole, which means, let's say, 5 crores. I'll say a certain portion of that 5 crores, let's say 60%, 3 crores is my performance materiality that I'm going to use to apply to all classes of transactions. That is the one approach. The second approach is I'll say, okay, while I understand that will be applied 3 crores across the financial statement, but I believe inherently inventories have a higher risk. Or let's say trade receivables has a higher risk. Or let's say purchase, because inventory is directly proportional to purchase of stock in trade. My COGS computation or purchase of stock in trade could, there could be, some errors because I've understood the operations of the company. I believe, basis my risk assessment, inventories of purchase of stock in trade could be higher proportion of risk compared to what you have for revenue and receivables. Let's say you've determined that. Then do you think, the simple question is, do you think that 3 crores is an appropriate number that is otherwise applied to, let's say, revenue and receivables also, should also be applied to this? In my view, the answer is no. You should therefore look at if there are heightened inherent risks or there are heightened reasons for you to believe that there could be a risk of material misstatement arising from the purchase of stock in trade or inventories, as the case may be, to the financial statements taken as a whole. I would reduce my 3 crores to maybe a further lower number, which means that 3 crores may not necessarily apply to all classes of transactions equally. So first, you will determine what is the audit materiality, which is relevant using the benchmark, which is relevant for the use of the financial statements. Then you will determine the performance materiality, which is to say that what is the amount that I will apply to the different classes of transactions to draw out the testing sample to be able to conclude that I have done sufficient work to opine on the financial statements, right? That's the third thing. Fourth, the attribute of 3 crore, whatever this performance materiality, may not be applicable equally to all classes of transactions. So there, I will then apply a lens of inherent risk or my understanding of the operations or control environment to say that, yes, I believe that there are these 2, 3 classes of transactions, which possibly I need to maybe increase the level of testing and therefore reduce my performance materiality from, let's say, 3 crores in my example to maybe 2.5 crores or 2 crores. Let's say there are qualitative aspects. Qualitative aspects could be there are very high chances of related party transactions not being getting detected or disclosed, right? Very high probability of transactions with companies which are so-called, not in appropriate, structure, and therefore potential fraud transactions. So let's say if there are these attributes, then applying one single performance materiality or classes of transactions may not be appropriate. So that's the concept of broadly the performance materiality. Now, as I said, I will, of course, also show you a standard document that we properly, one should, as an auditor, prepare to document the whole sort of concept of materiality, performance materiality, and so on and so forth. And then I'll also establish how this is linked to that SA 450 when we do the evaluation for errors that sort of come in. So therefore, please do keep in mind some of the terms that I'm going to show to you in the Excel file that I'm going to just put up for you. I hope you're following the sequence that I've laid out. I'll keep on sort of summarizing that for you so that it sort of registers, the sequence is registered with you. 315, 330, 320 between relevant. For determining 320, get to audit materiality, get to performance materiality, may not be a single amount, maybe different amounts applied for different classes of transactions or account balances, as the case may be, right? In doing the audit materiality, what is important is knowing the size and nature of your operation, of the organization that you're auditing, who are the users of your audit opinion and the financial statements, and for the users, what is the relevant benchmark? Because ultimately the number has to be drawn from the financial statements taken as a whole. Right? So I'll just try and put up the the amount, the document for you. Let me know if you can see this. Gaurav, you have to help me if in terms of whether this is really visible.
Yes, Ashish.
It is visible. Okay, awesome. So I'll just walk you through very practically how this typically needs to be documented and should be documented. I'll again tell you that if we get the audit materiality wrong, the consequence is that you will not be able to form an opinion under SA 700. That's a very clear underlying outcome that will happen if you were to not get this right. Therefore, as Gaurav also mentioned at the start of it, of the session, that getting this audit materiality right determines the entire audit process and the procedures that you're going to perform and ultimately form an opinion. So for you to get to that right, it is important that that is documented also uh, rightfully, because any reviewer or any regulator that comes in is going to focus first on how you determine materiality. What are the benchmarks that you've used? What are the different aspects on quantitative that you've considered? How you've evaluated why this particular benchmark is relevant for the users or not users. So I'll therefore documenting this is very, very important. And how we typically do this is that we typically look at what is the nature of the entity. Now, if you see nature of the entity, typical guidance which is available, whether it's under auditing standards in India or internationally or wherever there are guidances provided by, let's say, PCOB or other other relevant regulators, they've considered a listed entity. One of the important benchmarks is profit before tax. Now, that doesn't mean that will apply in as a mandatory across all listed entities. That's not what the guidance is. It is just a benchmark guidance, which means that for listed entities, typically the users look at profitability. Why? Because the share price and P multiple, as you rightly say, the P, the price to earning, is a very important area to look at for the investor to make a decision. And the price to earning is directly determined through the profit before tax. So profit before tax is really, and why not profit after tax? Because tax is really consequential to the profit before tax. So therefore, typically, if use PBT, that's the more relevant benchmark rather than a PAT, because tax, as I said, is more consequential in nature. Now, that's now the question that could come up if I were in our position is that, let's say I have a listed company, a lot of them are right now, who's not making profit, but it's listed, absolutely. But it's very, fast growing. Revenue is, growing at, let's say, a CAGR of over 25%. And therefore, it's making more commercial sense from a growth of revenue, but it's not making profit because the cost of operations is very high. Maybe it's a mid-stage company and so on and so forth. So the guidance doesn't say that if profits is not made, then you ignore that. You can also take loss before tax, uh, you know, or where there is a lot of volatility in the operation, let's say seasonality, or the business operations are at different stages, or they've added some newer businesses which are clubbed with the existing businesses and not giving the right picture. Then you can also choose revenue. Then revenue may be appropriate also. But then whatever you choose, there has to be a documentation of the basis of that. If you take profit before tax, then you can always refer to the fact that this is a generally accepted guidance available, and therefore we've taken profit before tax. The other aspect is if you're not choosing profit before tax, then my suggestion would be document the basis for it. Why you're not choosing profit before tax, or why you're not choosing losses before tax, or as the case may be. So there, just document the benchmark and then the choosing the benchmark, and the documentation will revolve around what is more sustainable, what is more looked at. Look at the investor communication, for instance, that the company has made or makes on a quarterly basis. What is the number, or what is the narrative that they are focusing on? Is a narrative around revenue? Is a narrative around assets? Is a revenue around you know, let's say, uh, uh, the EBITDA, what is the narrative that they are really focusing on? Maybe you can use that as a benchmark in that case. But this is just, as I said, guidance. This is an area of extreme judgment by any auditor, and that is why the guidance can provide you some insights, but ultimately it is your decision. That decision has to be documented, and then that documentation has to be sufficient enough to be able to demonstrate that yes, you've got it right in the first instance, and there are reasonable basis for you to believe that that's the right benchmark. As I said, the consequences of getting this wrong is that your audit opinion is wrong, right? Uh, for commercial entities which is not listed, again, very similar guidance. Profit before tax is typically taken. Otherwise, you can always use revenue. Entity that has very volatile earnings, again, could happen, multiple geography businesses, export, domestic business, cyclical, commodity pricing, volatility, then you typically can take a normalization of into your profits and then determine profit before tax. Otherwise, you can always have revenue as a benchmark. When you're normalizing the profit before tax, then you can take out all the abnormal items like impairment, one-off costs which are not going to be recurring in nature, and so on and so forth, to make sure that there is, as I said, more reasonableness attributable to the benchmark that you're taking, right? So these are just the guidance, which is, again, I'm reiterating, this is just the guidance which is available for you. These are not cast in stone. So it doesn't mean by default it has to be PBT. If there's no profit, then you can't take a benchmark. You can take a benchmark of revenue. You can take a benchmark of assets as long as you document it appropriately why you've done so. Right. So, so as I said, I think these are typically all these benchmarks revolve around revenue, assets, profit, or losses before tax, as the case may be. Uh, and now, once you determine what the benchmarks are, depending on the, let's say, nature of the entity, as you can see here, different nature of entities, then you come down to what is the right percentage, let's say, which will be applied to that benchmark for you to arrive at the right audit materiality number. Again, right now I'm focusing only on audit materiality. I'll come to the performance materiality later on. Now, in doing so, these are again guidance percentages. It's not specified under any standard. These are all basis experiences or different audit regulators, audit firms, auditors themselves, which have been sort of illustrated and elaborated in different sort of papers written by them and so on and so forth. So, and every firm, as I said, can follow a different uh, basis, as long as that basis of measurement is well justified and they can support that, yes, the eventual objective that you will be able to support your opinion that there is no material misstatement through that benchmark. If you're overall meeting that, then it's okay. And I'll tell you, a lot of times when you have very limited number of transactions, then you can even say that I don't want to apply the measurement. Let's say it's a very small company, 10 transactions. You'll say I'm going to vouch all the 10 transactions and then close on the opinion. Even though I've done all the 10 transactions, I know I don't need to apply a sample methodology, so there is no concept of materiality I'm going to apply. So you can have those sort of attributes there as well. So PBT, as I said, typically it's up to 10%. Generally, it's taken as 5%, like a median range to the 0 to 10%. Net assets also, it's up to 10%. Gross profit. These are all again guidances, not written in the standards. Gross profit up to 4%, EBITDA up to 5%. These are all that you can sort of use to say that, okay, whatever benchmark that I've chosen, these are all benchmarks, whatever I've chosen, whatever the number was of that basis the draft financial information that you receive, then I'm going to apply that number and these percentages to arrive at my audit materiality. Right? It's a simple maths then from there on. Now, once you've done the right selection of the benchmark and you've determined what is the right percentages that you're going to apply to that benchmark, then you come to documenting that in a appropriate work paper, right? And that working paper should document at least these attributes. The attributes, of course, of, let me try and see if I can have the laser pointer in this, otherwise, yeah. Attribute of, let's say, this entity name. What is the name of the audit client? The period that you're auditing, the entire 12 months, or you're auditing less than 12 months, or for that matter, if it's a quarterly review or a quarterly audit, right? Then you determine, through the various aspects, what is the right benchmark. That's where sort of you say that, okay, I've selected total revenues as a benchmark. Then you basically document why you selected total revenue as a benchmark. Just 1 minute, right? And then you sort of go down in terms of really taking down to what are the different adjustments that you'll make. And as I said, all of this needs to be documented appropriately in your audit work papers. This is the first document that, besides the engagement letter and your appointment formalities, from an audit working paper standpoint, is the first document that any regulator or reviewer looks at, because they have to determine that ultimately it is the right thing that you've done. Yeah. Let me go down. Right. So once you apply this, you apply the measurement principle percentage. Let's say let me try and see if I can do this. Let's say I've done revenue, right? Let's say I've done the estimated amounts to be 30 billion, right? No adjustments required. Let's say I've done the percentage to be 2%, right? Then the amount that comes out is 600 million, right? Then in that case, I will basically determine 600 million as my appropriate benchmark. Now, what we've also done, at least through our experience, is that whenever you're auditing, especially listed companies or NFRA companies, never have only one benchmark as choosing the materiality. Always use an alternative benchmark just to determine that ultimately the materiality that you are choosing is reasonable, right? If you were to look at different sort of attributes, let's say revenue and assets, if it's not profit making, otherwise revenue profits or profits assets, depending upon, you can take different combinations. And then once you've done this, let's say I've taken in this case, I take, for example, I take here total assets, right? And total assets I put down as, these are all draft numbers, so please don't hold me to that, right? Let me apply 1% as this, right? Now, once I've done this, then I can always choose what is my determined amount. Now I can say that I got the two benchmarks. Let's say my determined amount is 500 million, right? Which is lower than the benchmark, but higher than the benchmark two. So somewhere between, let's say, an average. Now, once I've determined this is my audit materiality. This 500,000, this number is my audit materiality. Now, as I said in the initial aspect, my audit materiality is one concept, but for the purpose of performing an audit, I'll have to choose a different materiality. Why? Because, for a simple reason, I'll have to do sufficient audit procedures to conclude on my opinion. Now, there again, the benchmarks that different firms follow is between 60 to 75%. So here, let's say 60% of this materiality, of this audit materiality, is what I've determined to be a performance materiality. So I've applied 500 million, it comes out to be 300 million, right? Now this becomes a performance materiality. Let me see what has happened here. That's not moving. 300 million. Now, when I've done the 300 million, now this 300 million essentially will be used by me in all my sample selections. Whenever I'm determining the procedures that I'm going to perform against different classes of transactions, let's say I've determined one only, I can choose more performance materialities. I can have different performance materialities for different classes of transactions, depending on the qualitative aspects that I mentioned earlier to you, right? But let's, for the simplistic situation, assume that this is my performance materiality of 300 million. This 300 million I will use to draw out samples for all the audit procedure I'm going to perform on revenue, on inventories, on receivables, on cost of goods sold, on employee compensation, other expenses, assets, liabilities, equity, whatever components of financial statements that I'm going to apply my test procedures for basis the risk assessments I've done. I said 315 to 330. The 300 million will help me determine the 330 and determine my ultimately samples that I'm going to draw it under 505. So coming out to be on the now once I've done that, now the other thing that needs to be determined is चलो जी हमने 300 मिलियन 500 मिलियन की हमने मटेरियलिटी देख ली 300 मिलियन हमने निकाल लिया कि भाई हमारी परफॉर्मेंस मटेरियलिटी क्या है अब उसके ऊपर लेट्स से मेरे पास मैंने प्रोसीजर्स परफॉर्म किए और प्रोसीजर से मुझे कुछ एरर्स मिले राइट देन हाउ डू आई evaluate those errors for two reasons. A, do I need to extend my sample? B, if I need to, if that's really that error is complete by itself, then how do I conclude that under 450? Now, in doing so, what you have to also look at is there is a concept of a trivial amount, which we believe that if there is any amount that comes in is not going to be material. Also, when you apply these performance material to different caption, which is $200 million or 200 million rupees, right? What if I were to apply 300 million on 200 million? It's not going to give me. It will possibly give me one sample as or whatever. It may not give me sample unless I apply a qualitative factor. Will do is I also look at trivial amount, which is typically the 5% of the performance materiality, and that comes out to be in this case 25 million. So that this 5% is typically applied on the audit materiality of 500 million applied at 5% comes out to 25 million. Now, what is the relevance of 25 million? Relevance of 25 million is caption which is 25 million or less in the finance statements. I believe that's inconsequential, trivial. I don't need to necessarily even apply audit procedures on that. I don't have to really bother about it. So done. Second is whenever I find error, then I will use this trivial amount at that time to determine what I need to do with that error being noted. Basically, trivial amount is representing the fact that in aggregate, even if you were to aggregate all 25 million errors in a certain account balances or captions, then the aggregate amount of that may not necessarily be material. So the probability of materiality of error resulting in material misstatements would be very low. So that's the whole concept of trivial amount. So there is audit materiality and there is performance materiality. I think trivial is more from a 450 standpoint, which we'll talk about later. Right? That's how we need to really put out a work paper. And I said, please document here. So let's say I'll say I want to document the basis of arriving at the benchmark. Sorry about my typing here, but benchmark are 1, 2, 3, 4, right? That's how you would typically document it. And that's where once you've done this, then as I said, you can have different performance materiality. Then you
Ashish, I think we are losing you again. think let's wait for Ashish to rejoin everyone, please.
Yeah, apologies again. Am I audible now?
Yes, yes,
Sorry, I
Ashish.
think there is some network issue at the location that I'm in. The first time I'm facing this. Apologies. But Gaurav, I don't know till when did my work paper session was there, right? You were there
Yes,
in my work
yes,
paper.
yes, yes, very much. You just have to reshare your screen.
Okay, okay, okay. Now
Yes,
it's
now it's
visible.
fine.
Okay,
Yes.
okay.
Maybe do you think, I mean, to save some bandwidth, do you wish to switch off the video and
No, no, I
try?
think it's not.
It's a sudden one
Yeah, yeah,
which,
because I'm the location I'm in, even though it's like the highest bandwidth available,
yeah,
but it's just switching off and switching on. That's the problem. I don't know why.
no
And
issues.
yeah,
Please carry.
apologies for that. Yeah. Okay. I hope the team is going to be following what I've covered thus far. Right.
Pretty much, it's very practical, Ashish, I must say. And we do have questions which I'm parking for the end.
Sure.
So, yes.
Sure. Sure. Yeah. No, I think the other concept I want to, once you've really determined the performance materiality basis, which I'm going to determine the number of samples or the test procedures, the extent of that test procedure I'm going to perform, then I think the other aspect, which is very commonly misunderstood, is that once I've determined the audit materiality, start of my audit, planning my audit, I don't need to revisit that. Then I'm going to run through this entire audit procedure and to the entire audit period. And then once I've concluded, then I'll do a 450 evaluation and conclude basis for the basis of my opinion under 700. Now that misconception actually has to be cleared. There is a requirement for you to revisit the audit materiality and the performance materiality as the audit goes on. And the simple reason for that is that when you plan an audit, you can only determine certain aspect basis of presumptions or your experience. Which, if presumption, if it's a new client, experience, if you've been auditing that client for many years, right? And then those presumptions and experiences may not fall true as you go along auditing for that particular period, which is under audit. And therefore, you may determine or discover transactions, you may discover certain areas which otherwise when you plan for the audit. I'll take you a classic example. Let's say when you went about auditing receivables, that's a revenue on receivables, and then you noted that in receivables, there are very, very small deductions which are made by the company, by the customers over the years, which for which adequate provisions are not made, right? For example, now that could also therefore directly apply to revenue number. Now, you may also therefore say that, yeah, is my performance materiality that I've determined on, let's say, revenue or profit, and the sample that I've drawn, is it sufficient enough? If I were to apply that same sample or that same performance materiality, let's say, to the gross to net, the net transactions in revenue, which are impacting both the revenue and the receivables, simple question, right? The answer is no, because these are small, small transactions. So then what you'll have is, qualitatively, you'll say, okay, for net, let's say discount, rebates, or credits, which are impacting my revenue and the receivables, I possibly have to revise my performance materiality because I am noticing many errors as I go along. Second situation, let's say there was a complete control failure on certain section of operations of the company. Let's say the company has three divisions. One division, while you did your test procedures, while you did your controls assessment was seeming to be okay. But when you did your audit procedure, you noted there were significant errors, maybe because of lack of control, that control being exercised across the year or for all classes of transactions. Whenever you have these kind of situations, that's a indicator that you should and may have to visit, should visit and may have to revise the audit materiality and the performance materiality, right? So therefore, whatever your procedures are, whenever when you're executing those procedures, always keep a tab. Am I getting any indicator to the performance of those procedures that require me to revisit either the audit materiality and or the performance materiality? I may not revisit the audit materiality, but may visit the performance materiality. I may visit the audit materiality and also then therefore consequently performance materiality. All of this determination has to be made by you as you go along progressing, and that has to be documented in your files. So once you complete your procedures, you should document to say that did your procedures indicate any instance which that lead you to conclude that there should be a revision in your materiality or performance materiality, as the case may be. And as I said, there are lower materialities for certain circumstances. Let again take an example. You notice that there was possibly a fraud in a certain element of transactions. Let's say advances given to related parties. Then you would typically not apply that performance materiality. You will actually go and 100% test all the advances. Or if it's multiple classes of transactions, you reduce your performance materiality to draw out more samples to be able to then determine and conclude that yes, that was just an isolated case, and in the subsequent samples that you've not found out anything else. Or that let's say your test samples have failed. You determined 50 transactions, you found out more errors in those 50 transactions, let's say more than 2 errors or 3 errors or 5 errors or 6 errors. There is a separate standard on it on determining whether a sample is a fail or a pass. Let's say your sample has failed because you've determined more errors, then you typically draw out more samples by reducing performance materiality. So there are reasons that could arise that will compel you to change your performance materiality and perform more additional audit procedures, as the case may be, right? But the revision typically is only for the purposes to reduce materiality and increase your audit procedures. You'll typically not have a situation where you determine that your materiality was way too low and therefore you need to change that. Then your determination in the first place was wrong, right? So your revision typically is for uh, reducing materiality number. As said, on the documentation side, please be very clear that while the materiality of the financial statements is for the financial statements taken as a whole, but you should look at if there are any classes of transactions or account balances where you need to have a different materiality applied, determine the performance materiality, and always call out for the revision. All of this need to be appropriately documented in your audit working files. As I said, the risk of getting this wrong is that you will perform insufficient audit procedures, have lesser number of or insufficient audit samples to be able to conclude the audit opinion, and therefore you could have a material misstatement which remains undetected, and you also will end up having wrong evaluation under SA 450 if you get this wrong, right? Always remember that there is an inverse relationship between audit risk and materiality. The higher the audit risk is, which I talked about with an example, the higher audit risk is, the lower the materiality would be, right? You'll never have a situation where there is a high audit risk and you have a higher materiality. It always has a inverse relationship, right? I'll just sort of, I think I've already discussed with you I walked you through the work paper, but I'll just summarize this that choosing the right benchmark is absolutely critical. Please involve a more senior member of the audit team in determining the right benchmark. Use your experience use the knowledge of the industry, use the knowledge of the client, use the information which is available in public domain from about the company and uh, of the company on their website and about the company through outside of their website to know what are the things that they're really talking about, what are the areas that the investors are really focusing on, which will help you not just determine the materiality itself, but also choose the performance materiality at different levels of transactions, right? Uh, you can have one performance materiality or have multiple classes of transaction materiality. Always remember that, and please reassess as the audit goes on. Right? That's a little bit of on the audit materiality. I'll move on to 450 now. Now, 450 really comes in when I've performed all audit procedures and I've noted that there are certain errors that came about in my test procedures. Right now, those errors could be either transaction specific errors or it could be judgmental errors, right? Now, transaction specific errors would be, let's say, uh, in my I noted that there are certain payments which are made subsequent to the reporting period, which otherwise should have been accrued but were not accrued as of the reporting date. Right? Those are specific transactions that you noted through your subsequent testing, and noted that those were not. Or let's say the classification of any financial instrument between a liability and an equity was incorrect. Now that's an error, right? That's a very specific error which is arising from that particular transaction or classes of transaction. Then there are certain judgmental errors. Judgmental errors would be, let's say, the company has done an impairment assessment. Now, in the impairment assessment, they have taken a weighted average cost of capital when you're determining, let's say, a discounted cash flow, a weighted average cost of capital as 15%. You believe it should be 18%. Right now, that's where the judgment are. Typically, in any significant judgment estimate areas in the financial statements, if there are any errors that you notice or there is a difference of view between the management, these are judgmental errors. Now, both of these errors are dealt with differently in SA 450 and practically when you go out and concluding whether your opinion is impacted or not impacted. Right now, yeah, in a it's on right, yeah, in a situation of error being identified, the common mistakes that people do is that once they determine the error, they do not necessarily conclude that error to be appropriately from all perspectives. What are those perspectives? Perspectives of control, perspectives of fraud, perspectives of representative of the population, perspectives of whether it impacts my other captions or account balances or transactions. Let's say I've determined that the certain liabilities are not accounted for. Do you think it only has an impact on liabilities? It will also have an impact on your profits. It will also have an impact or assets, as the case may be, or it will also have an impact on social impact on your taxes, which is consequent, as I said. So it may have a multiple effect. So an error is therefore needs to be carefully evaluated in terms of determining A, it represents the population coming from a transaction per se. Second, it cross linkages with the other elements of the financial statements. Third is having a root cause to determine that, if it indicates fraud or not, or misappropriation of either assets or, deliberate misreporting of the financial statements. So you have to therefore look at that error into different attributes or allocate that to different attributes and then make a conclusion. Very common mistakes that people do is that whenever lesson error is identified, they just look at the materiality number and say whether that materiality number, that error is lower or higher. If it's lower, then say it's not material to the financial statement and conclude without really realizing its cross linkages. And we've seen many examples, both NFRA, Institute, QRB, or in the PCOB for the US. This is a very common area of where they found audit files and audit conclusions to be deficient. A very common area. But because what people do is that they just look at those errors in isolation. They do not follow the procedure and the process laid out in SA 450. So therefore, you have to very carefully understand what is this error and how that error is needs to be evaluated. And I'll show you a work paper and then give you an example on that to walk you through that. As said, misstatements could result, of course, from the fact that there was a transaction not accounted for in accordance with the accounting standards or the substance of the transaction contract. Let's say there was omission of disclosures. There is estimate which was not appropriately recorded. Let's say you're creating provision for doubtful debts on some estimate basis, but on actual they are much more or much less, as the case may be. Actual debtors going bad, so the estimation process may not be appropriate, and therefore there could be an error occurring, or for that matter, it was a wrong selection of accounting policy, inappropriate selection of accounting policy in the first place itself. So there could be many reasons, that could result from into a misstatement. There's another misnomer. Misnomer is that, let's say there is a disclosure not given by the company, which is mandated under the standard. Now, that disclosure omission doesn't need to be valued under 450. Every single misstatement, that's also, by the way, a misstatement. Your financial statements are not just about numbers. They're also about how those numbers are presented and what are the disclosures relevant for those numbers. Both of those are very important things. Let's say there is numbers are right, but they're presented wrong. Classic case, financial, non-financial assets. The number is right, but a non-financial asset was presented as a financial asset or vice versa, right? Then it's an error, misstatement. Let's say a fundamental disclosure is missing. Revenue Ind AS 115 gives you a laundry list of disclosures that need to be made in the financial statements. Schedule 3, Division 2 or Division 1, as the case may be, gives you certain disclosures and certain way the financial information is to be presented. That says there is omission on that. Even that is a misstatement. So a pure error from an entry is not necessarily an error. A disclosure is also an omission of disclosure, or an incorrect disclosure is also an error. So that's another misnomer. Please get it absolutely right. That you can't have a situation where it's you only look at the accounting entry and say, यार मतलब अगर ये उसने disclosure नहीं दिया तो कोई बात नहीं, that's fine. That's just a disclosure. That's also an error and needs to be valued under 450 as well. How relevant and material that disclosure is. You will apply different benchmarks for evaluation of disclosures and all of that in presentation. That is typically the case, but has to be evaluated. Right. Now, whenever you do, and in terms of the closure of what should be, how you should assess a misstatement, always make sure that whenever a misstatement is identified, it means just open a work paper and show it to you through that. It's a blank work paper, but I'll draw it out and then draw the analogy for you, similar to what I've done for materiality. Just give me a minute. And Gaurav, it's visible.
Yes, Ashish.
Okay. And apologies, I'm going to draw you because again, because of this network
No, that's
issue.
very much there. Please.
Yeah, thank you so much, brother. Right. So I think, as I said, I'll take this sort of example. Let's say your entity name is ABC Corporation. Your period is 31st March 2024. Materiality, let's say 300 million. I don't know if I got the millions right, but nevertheless, 30 million away, 300 million. Trivial amount would be, in our example, was 25 million. Right? So let's say there is a misstatement. Now, what is a misstatement? Let's say our certain liabilities were not recorded. It should have been recorded, right? Those were basic accruals which were not made, right? So let's say that you described accruals for expenses not made. Whether it's a current period or prior period, let's say, so that's the first determination to do. whether this error relates to your current audit period or the prior audit period, right? What is the type of misstatement? Is it factual? Is it judgmental or projected? I was saying different kinds of misstatements. Let's say it's a factual misstatement. There's no judgment involved. It's factual. Certain expenses is not accrued, should have been accrued. It's factual, right? That is determined through your search for unrecorded liability test procedure. Account number, let's say, is 1234, will be depending upon the chart of accounts of the company, right? And then you say, what is the account name? Let's say it was sales promotion. Again, these are all hypothetical situations. Please don't hold me to any of the amount. Yeah. Now, this is, of course, the amount involved. Now, here the next thing comes in, very, very important. This, as you see this, right, the same thing. Let's say there's only single transaction. If there are multiple transactions, then you can sort of come in. If it's debit credit, let's say the liability amount, let's say the other element is, this is expenses. The other element would be expense provisions, same amount. Of course, this is the only error. Let's say this is the only entry that you'll say. There'll be consequent tax impact also, right? So what should be the entry then to that extent? Do you think there'll be more reduction? Yes, absolutely there'll be more reduction, right? To that extent. So you say tax liability, and then you'll do current tax expense. Let's say your tax rate is 25%. You'll apply 25% here. You'll apply this. This is your effect of one single entry, right? Now, what you have to determine is what is the real cause of misstatement here. That's the first. That's the very important determination. Let's say your cause of determination is accounts manager missed considering in financial statements. Do you think this is a sufficient argument or explanation? What do you think? This is, in my view, not, right? Why? Because this is indicating a fundamental and systemic issue in your financial statement close process, right? So what you have to then do is to say that, okay, if the accounts manager can miss something like this, right? Sales expense not being sort of accrued appropriately, there could be other accruals also, which could be missed out, right? So the first thing that you will do is, first thing you'll do it is review and revisit your audit procedures for unrecorded liabilities. Unrecorded liabilities. Second thing you'll do it is, it's a clear indication of a failure of FSCP, financial statement close process, which will have a direct impact on your ICOFA opinion, right? Your internal controls over financial statements opinion, direct impact. Why? Because it's a failure of our FSCP. It's a material amount. It's a material amount, right? And this is resulting from the fact that the accounts manager very convenient, which means that the accounts manager possibly didn't know, or there was no process to compile a complete information. Also, there is a lack of review of the accounts manager work. All of these are controlling this misstatement, right? So first revisit that and then conclude. Now, let's say if you've done this A and you've concluded that there are no other such situation, then you basically evaluate for ICOFER and failure of the FSCP and possibly modify your opinion on ICOFER, right? That's your first thing. The other thing that you'll do is that because the company has corrected now this sort of misstatement, let's say because I've just put it down under the corrected misstatement, you will basically, after you revisit it, you'll document that in your relevant work paper of this audit procedure for unrecorded liabilities that you've noted this error. These are the additional procedures that you performed. to mitigate that this is indeed the only actual error in your representing that entire expense provisions and all of that, and therefore you are satisfied that no further procedures are required. So that's how you will close the let's say for this. Let me give you another example and then correlate to that, right? Another situation, current, let's say current factual 4, 5, 6, 7, 8, right? Uh, let's say advances provision for advances financial asset, right? Let's say 40 million. Now you'll say, what is the reason for this? You'll say advances to RPTs not at arm's length. Now, this is a serious issue. Now, one may, and this is where I've seen most of the teams really making an error or having a issue with respect to documentation. Whenever you have this, they'll say यार entry डाल दी client ने ठीक हो गया अब तो accounting ठीक कर दी हमने देखो advances की entry डलवा दी. But if you see, this indicates a serious issue that should this not be evaluated from 143.12 perspective? That there was indeed that you're writing off an amount which is paid to a related party, right? First of all, what is the reason the advances were given? Why those advances were not recovered? Even though the amounts are not material, you'll say, "यार, 25 million का है मेरा, 40 million is not material at all. It's just above my trivial amount. How does it matter?" Right? So 4 crore का तो amount है. My financial statement materiality is 50 crores. Performance materiality is 30 crores. 4 crores, single transaction. I don't need to expand my procedures also. This is the only transaction. But why does it not indicate 143.12? So have we done that evaluation? So you'll have to go down to determining A, the purpose of the advance, why done not at arm's length, arm's necessary approvals, right? And why writing off? Ask yourself under 143.12 to determine if there is indeed a fraud in this situation as well. So do not take corrected or uncorrected misstatements on face value. Go down to the root cause analysis. Go ask yourself, why has this misstatement occurred? What is the underlying control deficiency? By the way, there is also control deficiency here. The control deficiency is also with respect to FSCP not being FSCP failure. Now, so you'll have to do this kind of a determination. The similar thing we'll have to repeat for uncorrected misstatements. The only difference is that while in corrected misstatements, this is already being impacted in your financial statements. In case of uncorrected misstatements, these have not been impacted. So what you have to therefore also do is determine how your numbers look differently in assets, liabilities, and equity income. Income means profit and loss account if these entries were to be recorded. That's your simple determination, different from corrected to uncorrected. But other than that, you'll do the same evaluation. See, you'll do the same evaluation of what is the cause, as you can see here, what is the cause and related control deficiency. And also, if there is any linkage with 143.12 or control ICOFER report, you'll also make an assessment for uncorrected misstatements of linkage with the other financial aspects, which are correlated, right? So as I said, this is your correlation, tax liability. So please make sure. Let me take an example. Let's say there is the misstatement is that the company has not done mark to market of contract, right? let's say it's a current period. This is factual because it's either done or not, binary. Account number 345. Account financial statements would be what, right? M2M expense. Let's say it was an expense. And then financial derivative asset or liability, right? This is your debit credit. But do you think this is only
If we have lost you again, it seems. Let's wait for him to join back. As he has already mentioned, there is some technical issue at his end.
right? I'm back, right, Gaurav?
Yes, Ashish. Looks like there's a fixed timer.
Yeah, that's all. I can now half an hour. It's just switching on and switching off.
Yeah,
I also
there's
noted
some.
that. I didn't know that this situation would arise. Apologies for that. But anyways, coming back to my point that you would do these correlations of what are the other things that are getting impacted, and then make a determination of how the impact would be on different elements of your financial information. So let's say, take this example only, 30 million, let's say 30, 100 million over here, if I'm not mistaken. $30 million, right? Let's say tax is not tax was not thought through, so you'll have a tax consequence also, and there is disclosure. Disclosure in the numbers that you'll have to put it down as separately. Let's say tax impact of this is also into 25%, right? So do you think where this all should be? It'll impact, of course, the assets. So let's say minus 30 million. It'll impact your equity. It'll reduce the equity by 30 million. It reduce the income by 30 million. So this is the very different aspects that it'll be impacted, right? It will not be just impact in one line item. It'll impact in different line items, right? There'll also be impact of tax. Tax will be where, let's say, liability. There'll be impact on equity, and there'll be impact on net income as well, right? That's how your evaluation will happen, and then you'll put down what is the percentage basis the final materiality. Let's say your materiality number in our case was 500 million. You'll put down the what is the percentage of this materiality, and then what is the financial statement totals? What are the totals of assets, liability, and then you'll determine what is the percentage impact. So this is a quantitative way of determining if there is any material impact is uncorrected misstatement. In this case, you can see at least quantitatively there is no impact on material impact on the relevant financial, and the assets, liabilities, equity, income presumably will be higher. But let's say, let's take an asset example, 800 million, assuming the same as liabilities and equity. Sorry, I'm taking a weird, but just to demonstrate numbers to you and help you arrive at a conclusion. But let's say net income was only 30 million. Right? So the percentage impact of this is actually very significant, right? It's when you do apply percentages, it will come out to be 75%. Right? So it's 75%. Now this is material. Can you see this is a red zone. So while X qualitative aspects to say that was just a mere 7 million of that. And therefore, even though this is not really considering my financial statement material and on the asset liabilities and equity, but let's say for the income, because of the share, I have to call my out opinion because I can't say that my net income of 30 million is true and fair view, knowing very well that the 20 to 75% of that is an uncorrect statement, which will bring down that 30 million to 7 million. So you have to always draw these correlations. Again, a common issue people don't, because what happens is they don't necessarily follow this kind of a template. So please follow this kind of template where you document what is a misstatement, what is the period it leads to, whether what kind of a misstatement it is, how, what are the control elements or other elements of this. Please note all of that and then make a conclusion around it. Right? This is how you would typically make a assessment. Now, forward contract, you have to make sure that there are disclosures with respect to that forward contract, which yeah, evaluate the money in terms of the whether this is material or not, depending on the relevance to the financial statements taken as a whole. Repetitively material. So let's revise this number to 300. Okay. Is the materiality? I don't need to bother about it. Then it's okay. But disclosure perspective also, I believe that financial statement derivative contract was just another element in the financial statements, and therefore I don't think so. Even if the disclosure is missed out, statement in the financial statement. So while I understand numbers are not adjusted, there was a possible tax consequence. Different line items got. There was also disclosure got impacted, but I believe, or on an overall basis, financial statements taken as a whole, the numbers are not, or the overall numbers are not materially misstated. My opinion need not be modified for this misstatement. Relations, look at consequential impact, look at disclosures and other presentation elements, go into the RCA, go into controlled efficiencies, revisit working papers as I have done in this case, in case of a corrected misstatement, right? And then make a appropriate conclusion in the work paper. I'll also give you a concept, and I'm running a little short of time here. There's of aggregation of misstatements, right? The concept of to say that how do you deal with different smaller numbers of, let's say, 50 million, 500 million. This is only 50 million, right? Issue of 35 million. So first of all, the action is required for similar underlying control attribute. So what you have to do is, because the first impact is on the control. Then for every FSCP, you'll aggregate all small entries, aggregate, and then you determine whether this was indeed a control failure or not a control failure. Because every single thing would mean that there was a fundamental control which didn't work, especially at the FSCP. Some had to do, but then typically controls can be mitigated through entity level situation, may not necessarily consequent mitigation. and it may end up in that. So aggregation is very important. Whenever you have small, do not close them into. They relate to the same caption of financial line item, control element, attribute, another presentation element of the financial statements. Misstatements therefore have to be evaluated individually and also in aggregate. So let's say in this individually, not material, but let's say in aggregate, this will be 90 million, well above your trivial amount. And let's say there are more transactions, it may go up to 500 or 600 million only with respect FSCP only, different line items. So you have to do that evaluation individually and in aggregate. Concept I want to talk about is which is pretty uh, complicated, is actually judgmental misstatement. So let's say I given situation, the company has passed and has made a determination of impairment of an asset, or they took a WAC of 15%, which is that be 16% or 18% or 17%. What you have to do there is, whenever you have matters of judgment, always apply a concept of sensitivity. Means that you'll have to therefore see a, first of all, whether 18% in your judgment and 15%, how does that move the needle? Let's say it moves the needle, this is resulting in an impairment. That is where you have to go deeper. Let's take an example. The company has a goodwill of 100 crores. The company has determined using 15% of WACC that there is no impairment of to the goodwill of 100 crores. But you've done your calculations and you determine that if I were to take 18% WACC, there'll be an impairment to the intangible that goodwill, not intangible, but goodwill. And that impairment, if applied 18%, would be, let's say, a range of 10 crores. Now, that is where your determination will happen. That's one situation. We'll elaborate on that situation. The second situation is, let's say, even if you were to apply 18%, the 100 crores of goodwill is not impaired. If this is that situation, then the 18%, 15% does not make a difference. Close it in your work papers and move on. That there is sufficient headrooms. Even if you were to apply 18%, move on, no problem. But let's say if you were to do this scenario, in the first scenario, if you were to apply 18%, then your misstatement could be up to 10 crores. Right? Now, this is a judgmental misstatement, not a factual misstatement, a judgmental, because it's not arising from actually a statement of fact. It's a matter of judgment. Why not? Why 18%? Why not 15%? And so on and so forth. Right? There, while you are concluding it, it could you have to apply a little more experience in this than what we just talked about. That experience essentially will come from the fact that whether this judgment is resulting in any consequential or linked, let's say, a management incentive. Why has the management taken 15%? Are they trying to stop or not have an impairment in your records? For what? A, was there any guidance released to the market that this will be your net income? Was there any management incentive plan linked to a certain targeted amount of, what is the reason that, or what is the consequential impact of this 10 crores going to be on the different attributes of net income, management incentive plans, and any guidance that the management has given, right? Those are qualitative aspects. If there is no impact of that, then what you do is you typically say that, okay, I believe this 10 crores is not material because my materiality is way above 500 crores, or it's 500 or 500 million, 50 crores. This 10 crores is not material. It's therefore, I will just close it as an uncorrected misstatement. It does not result in any IPO kind of a situation because it's a pure judgment necessarily. Company has adequately got the expert involved, got a management review done, and concluded 15%. They have their own basis. I have my own basis, right? And concluded there. It does not require me to revisit any of my other audit procedures and just close it there. Let's say if it is 60 crores, right? If it's 60 crores, That is where I think you'll have to go down to possibly modifying your opinion, unless the company basically changes its workings to have that to be in line with the 18% or whatever, because you have your own basis, and I'm sure your basis will be justified, and that's where forming an opinion is all about, right? So judgmental misstatements are a little complicated area. I would suggest that they should not be left to junior members of the team. Junior team members should always be looked at by senior team members and carefully examined into qualitative aspects, especially around management incentive plans and what correlations can that be drawn to, right? So that's a little bit of your misstatements. I will stop now because otherwise I'll not be able to take questions. I know I may not have covered everything entirely, but I wanted to give you a flavor of what 320 is, what 450 is, so that you can practically at least make some determinations and whatever changes that you need to make in either determining those amounts, applying those amounts, and concluding thereof, you're able to do that. I'll stop here. If there's any other.
Thank you, Ashish. A very insightful session as always from you. Quite elaborative in the given time frame. I think you have covered most of it, and the good part is, I would say, the practical working which you have shown. I think that is really helpful for all our members. So we have some questions for you. If we should go with it, then I'll take the first question: that how technology can assist an auditor in materiality assessment.
Sorry, how technology? Can you repeat the question?
How technology can assist an auditor in materiality assessment.
No, I think the technology will only be with respect to making the right assessments. So there are multiple ways you can use technology as a feeder to your judgment. First is doing the right determination of what could go wrong. That could be used. Technology can be used to analytically review the financial information, look at the external information, internal information that's available with the company to make the right determination, and then conclude if you were to have one performance materiality or have different performance materialities, right? I think that's where, if possible, you can use technology in making the right uh, determination, both in terms of benchmark and the amounts involved in those benchmarks.
Fair enough. I think that's well answered. Then the next question is, consequences an auditor may be subjected to in case any transaction is not material misstatement according to him initially, but is a material misstatement according to another CA. So
Yeah,
I don't know. I mean,
yeah. No,
yeah.
no, very, very good question. Very good question. At the end of the day, materiality is a judgment. I may
Yes.
have a different way of looking at materiality, and the other one could have a different. See, first of all, the auditing standards give you a kind of an assurance, or I would say an insurance. If you were to follow the process of determining the materiality, which means that your documentation is appropriate to say why you've chosen a certain benchmark, why you applied a percentage on that benchmark, why not less percentage, why not more percentage, right? If you're able to document that appropriately, then the other person may continue to have his own or her own perspective. You will be able to substantiate your work appropriately and adequately. That is one. Second is, if it's a existing client or recurring client, you can use your experience of a recurring client to say that in your experience, you've not noted any misstatements in the past, and therefore your determination is appropriate. If it's a new company, you can use the industry experience to say that in the industry, this is why I've chosen this benchmark, this is what I've chosen, why I've chosen a lower. Whenever it's a first client, I would, and good, you're discussing this question. I have, for example, always used slightly lower end of the percentage of the measurement, percentages in the first year client, because you don't necessarily know the aspects. The other thing that you'll do is, while you perform the procedures on that, if there are no misstatements that you've identified through those procedures and all your test procedures were passed, then you can also use that to substantiate that your determination was did not require it to be revised because you did not notice anything as any issues around that. Other way to also look at is break down your audit into standard and non-standard. Always say that your non-standard transactions, you should look at it 100% anyways. You'll say that boss to anyone personally, यार देखो हमने non-standard transactions सारी देख ली हैं. Standard transactions के अंदर these are routine transactions. We've done strong control evaluation, no issues. This is the way we've determined the benchmark. I've documented it. We applied these stress procedures, no issues. So therefore, in our view, the opinion is substantiated, right? There could be situations where fundamentally the benchmark or let's say materiality amounts could be different. I'll give you an example. Let's say it's a competent auditor or it's a parent auditor situation. A competent auditor may determine materiality basis his judgment, whereas the parent auditor can have a completely different judgment depending on the materiality of that component. Let's say the component is very material to the overall financial statements. The other components are loss making. This component is profit making, and therefore, in the consolidation level, this is much higher. So, on a standalone basis, this component will have a higher materiality for the competent auditor, but a lower materiality for the parent auditor. That's for the parent auditor to determine. They may then instruct you to perform either more procedures or perform the procedure themselves. But they can't tomorrow falter your opinion, standalone opinion on that component.
All right. Fair enough. The next question which we have is so someone from a refinery PSU, so they're asking that for a refinery PSU, would profit before tax PBT is the better benchmark for materiality? And is it fine to change the benchmark in current year compared to the previous year set by erstwhile auditor?
Yeah. Again, a great question. First of all, refinery again typically is a commodity, prices being involved, and there'll be fluctuations. So you can actually have revenue as a benchmark for that, provided that revenue is a more representative benchmark in that industry. Again, looking at how the investors look at that particular business or that PSU. There could be elements of costs which are non-controllable. There could be elements of costs which are controllable, which are just so complex. So especially in the petrochemical business, let's say commodity prices by itself will drive the profitability significantly over the period. Default is profit, but if you're able to say that, okay, profits are not stable because of reasons beyond the control of the company, the revenue possibly is a better benchmark. But in that case, compare it with your profit. So that's the first thing that you should do. So let's say you've chosen revenue as a benchmark. Revenue numbers से जो materiality आएगी और profits से जो materiality, compare that. If this is not significantly different, then it doesn't make a difference. If it is significantly different, my suggestion would be take an average. That's a better way of concluding it on that. You can, of course, change the basis from last periods if you have the reasons for doing that. As I told you, more experience, significant fluctuation in profits because of underlying commodity prices is a classic example for changing. But please compare it with another benchmark and then choose either have an average or choose the lower of the two. It's better to be, since it's a first year audit for yours, because you said that you're taking erstwhile auditor had taken PBT and you're evaluating as a first time audit. I would always err on the side of caution. So go with a slightly lower benchmark in that case, is my advice to you.
Fine. One more. How benchmark would be determined where the last auditor or previous auditor has raised concern over going concern of the entity?
Yeah. So I think, well, going concern and materiality are two different sort of concepts here. Performance materiality particularly. So if let's say there is an emphasis on the matter on material uncertainty on going concern, right? Your inherent risks generally will be very high. That's the first default situation, right? Because why the company would try and or the management default position would be, or underlying inherent risk would be to make sure that the numbers are shown appropriately. There could be some classification issues. It could be certain recording issues on that. So inherent risk goes up. When inherent risk goes up, your materiality, remember that equation, risk goes up, materiality goes down. So in that situation, you should typically lower your materiality number, have it to the lowest possible in the benchmarking criteria. And in that case, please have 2 or 3 benchmarks, choose the lowest of them in this situation, because it's a very elevated inherent risk situation here.
Thank you. Maybe a couple of more. One is on how can auditors actually handle the situations where management disagrees with the assessment of the materiality or propose adjustments. So, what should be the response and how the situation needs to be handled in your experience?
Yeah. Again, great question. First of all, materiality is your materiality, is not management's materiality. Management could determine whatever materiality they believe they have to look at it, right? It's your, and therefore it's your conclusion, your opinion. If you have determined an amount to be material, on misstatement to be material in your this thing, you have to form a judgment on that, irrespective of whether it was material for the management or not. Of course, my suggestion and how I practice is I always listen to what the client has to say and do a qualitative evaluation also in determining that, okay, if I were to, let's say, modify my opinion for this issue, if I were to modify my opinion for this issue, would it really, I mean, would that be an excess situation or not? That's a qualitative assessment that I would make. But if I believe that the amounts are material for my purposes of 450, irrespective of whatever management says there, I'll modify my opinion. It's as simple as that. And that will be the case in any situation. I'll tell you, boards typically define or companies typically define materiality very differently. They'll say 10% of revenues, they'll say 20% of assets. Is if there is any issue that results in 10% of revenue, that for them is an action point. But that's not necessarily your materiality, right? Because ultimately they're third parties who are relying on your opinion. So if you believe that you've taken 3% of revenues and there is an error which is 4% of the revenues, you'll have to either the management has to correct it or the report has to be modified, provided the qualitative assessment is backing your quantitative conclusion.
Sure. The last one we can take, maybe I feel, that's how do regulatory requirements you see impacting the auditor's assessment of materiality, especially in a condition where it's very highly regulated industry. So do you think the regulatory requirements also have an impact somewhere while we are making an assessment of materiality?
No, no, absolutely. I think they would have. Uh, First of all, regulated environment means highly elevated inherent risk. Second is you have to determine what are the direct consequences of the regulation, in what account balances those regulations will typically apply. For instance, in pharma scenario, gross to net is a very important area. Accrual of expenses is a very important area. Your inventory expiries are a very important area. So for those areas, you could have a different performance materiality because you believe that there is a highly regulated environment there. Let's say tomorrow the company in a when let's say the regulation clearly says that you cannot sell an expired product, right? So near expiry provisions are a very important area to focus on. So your inherent risk in inventories goes up, and your performance materiality could come down for that particular element. So it'll definitely have a direct correlation on your how you determine materiality, or you rather how you apply materiality determination on different account balances.
I think we are done with the questions for now, and maybe we are good to close right now. So yeah. So thank you so much thank you so much, Ashish, first of all, for being there, and I think for giving such practical insights. As I said, I think you have we have answered the questions also and clarified the doubts of our participants in a very fair manner. So this will definitely help all of them. And thanks once again, Ashish, for your time, and to all our participants as well and attendees. Over to you, Anilji.
Yeah, first of
Thank
all,
you so
thank you
much, sir.
and apologies, Gaurav, and to all the participants. I know the technology didn't work today as planned,
It's
but
perfectly fine, sir. It's just due to the technical glitch.
yeah.
So thank you so much, Ashish sir, for such a wonderful deliberation. You have justified with your presentation and in a very lucid manner, with a full of examples and practical way, you have shared the expertise with all our members. So frankly speaking, first time I have seen this type of presentation along with the practical examples on these two standards. So thank you so much once again for sharing your knowledge with all our members. So from the core of my heart, as well as on behalf of AASB of ICI, I extend my heartiest thanks towards you for sparing your valuable time and sharing your insights with all our members. So thank you so much, Gaurav ji, also for adding your expertise for this particular wonderful session. So thank you so much for sparing your time and moderating this webinar. Thank you
And
so
thank you,
much, Gaurav
Gaurav.
ji.
So
Thank you so
absolutely.
much.
Thank you, Gaurav.
Thank you. Thank you.
Thank you so much. Thank you, Anil ji, for giving the
Thank you.
opportunity.
Thank you, sir. Thank you.
Everyone.
Thank you.